Many people spend their entire working careers doing exactly what they were told to do. They contribute to their retirement accounts, they max out that 401k, delay taxes as long as possible, and often this works very well during the accumulation years. But later in retirement, those larger IRA balances can create some planning challenges. Welcome to another episode of the Simply Retirement Podcast, where we want to educate and empower women to live your retirement on your terms. I'm your host, Eric Blake, practicing retirement planner for over 25 years, founder of Blake Wealth Management, and I would not be the man I am today without the women in my life. Joining me once again is Wendy McConnell. Wendy, how are you?
I'm great. How are you?
I am very good. So I was going to ask you a question, then I realized that after you've been on vacation yourself, it might be a bad time to ask. I'm like, every time we take a little bit of a break of recording, there's always like this nervousness, like I'm kind of starting from scratch once we get back to recording. I was going to ask you, so how did you, as a seasoned professional, how do you deal with that? And then like, well, she's been gone for 2 weeks herself. What am I going to
No, I don't know. As a seasoned professional, you just pick it right back
You
up,
just do
I
it?
guess. Yeah, but I've been doing it a lot longer than you.
I know. Well, that's what I was going to ask. I'm like, well, but she's been off herself. She may not have a great response. I don't know.
No, and I'm not shy. That's always a big help as well.
There you go. That's always a positive. That's I would definitely consider myself an introvert for the most part, but it's the one-on-ones that I feel like I'm much more confident in. But so talking to you makes me feel good. How's that?
Oh, that's so sweet. But you do a great job, Eric. Truly.
I
so.
appreciate that.
All right.
So today's topic is a lot of my topics that I come up with for the show are based on conversations that we have with clients in our retirement planning practice. And that's the same with this one as well. We had a client, she had met with her recently. She had lost her husband a few years ago, and she's going through a shift in tax rates from the married filing jointly. So in the year that her husband passed, she could file married filing jointly. Then she was actually able to qualify for what's called qualifying widow status the year after that because she had a daughter that was still a dependent, which is one of the requirements for that. And the key with that is that and we've touched on this in past episodes, but the key there is that the rates are very similar to married filing jointly, that qualifying widow status. But 2025 was the first year where she actually was filing single. And so you're saying, okay, tax rates have been cut in half, or income for those tax rates.
Right.
So that's really where we've started looking at the fact that a lot of the flexibility that we've had the last couple of years has kind of disappeared. It's really not there. And she's not eligible for Social Security yet. So there's some factors that we're trying to work our way through. But that's one of the things that we were talking about is something called a retirement tax cliff and how that fits into the bigger picture of retirement planning, especially for women who may be going through these financial decisions on their own after divorce, after the loss of a spouse. And we're talking about a retirement tax cliff, what we're typically referring to as potentially a sharp increase in tax rates, right? Going from married filing jointly down to single.
And then we can push them off the cliff.
Right? And we push them off the tax.
No more taxes.
Not exactly. Unfortunately, it's the reverse of that, but it could be a sharp increase in tax rates. It might be a spike in income for different reasons. We'll talk about some of those. And what's ultimately important is also it could be just a relatively small income decision in one area of your financial life creates a much larger financial impact somewhere else. And it may not be planned for. You might not even be aware of it. And that's really the purpose of the episode, is to talk through some of those tax traps that might be hiding out there to give you at least some awareness. And ultimately, as it always is, about asking the right questions, seeking out the right information to make better decisions. Because in retirement, it could be that one single decision might affect Medicare premiums. It might impact Social Security taxation, healthcare costs, deductions that you might be eligible for. But ultimately, it's about how much it can impact how much income you actually get to keep in those retirement years. And for widows in particular, this becomes even more important because of something we've talked about in the past called that widow's penalty. We've had episodes on that, but it's ultimately where the household income might decline some after losing a spouse, but the taxes, even Medicare costs, can actually sometimes increase, sometimes quite a bit, because the surviving spouse is now filing as single versus married filing jointly. Even with divorce, even though it's actually different emotionally, legally, some of those aspects, many divorced women can actually experience very similar challenges after transitioning from married filing jointly to single. I think one of the biggest mistakes I see is people assuming that retirement taxes work the same as they did during your working years.
They don't.
Not really. Because a lot of people focus simply on the tax brackets. It's what tax bracket am I in? How much can I save into my retirement accounts to reduce those taxes? And during the accumulation years, that actually can be perfectly reasonable. That might be a good approach to take. But with retirement income planning, it is very different.
Mm-hmm.
So today we're going to walk through several of these hidden retirement tax traps, why they matter, and some planning considerations that may help you avoid these unintended surprises down the road.
All right, let's do it.
So let's talk about just again, kind of that idea of what a cliff is. And we're talking about retirement planning. Again, most people in those working years, they're thinking about just tax brackets. And then they think that same thing as they get into retirement, because they might say, well, I'm in a 22% tax bracket, or I'm trying to stay in the 12% tax bracket. And one thing that makes retirement tax planning confusing is that many people, again, assume that the tax rules work like ordinary tax brackets. In other words, if you think, if I'm moving into a higher tax bracket, it's only those dollars above that threshold that are taxed at the highest rate. Because if I'm just a single dollar into the 22% tax bracket, it's only that $1 that gets taxed at 22%. But that's not necessarily the case when we start talking about some of these retirement taxes that you have to be aware of. And so when we're thinking about a cliff, again, it often works differently. So in some situations, crossing a specific income threshold by even a relatively small amount can create a much larger financial impact somewhere else. Okay. And a good example of that is Medicare IRMAA surcharges. So those additional Medicare premiums you might have to pay if your income crosses a certain threshold. And with Medicare, it is really important because it is just a single dollar. If you go into that next threshold by even a single dollar, your Medicare premiums will increase. It's not by $10 or thousands of dollars. It is by $1. If you're into that next threshold by a single dollar, your Medicare premiums are going up.
Lovely,
right? But it's creating awareness. And then you also think about like Affordable Care Act, what some people refer to as Obamacare. Those subsidies work a little bit differently, but there are situations where going above certain income limits can significantly reduce, maybe even eliminate these tax credit or subsidies that might be helping you pay those premiums. And so that's something you've got to be aware of as well.
Okay.
So you got these other retirement cliffs are less about just that $1 and more about a major shift in income itself. So for example, we have required distributions that can suddenly introduce a new layer of taxable income into a retirement plan that affects taxes. It can affect Medicare premiums, other parts of retirement planning all at the same time. And additional income can also cause more Social Security benefits to become taxable. It might increase your capital gains exposure, depending on what type of investment assets or even real estate assets. And it can even do some of these new deductions that are available through the new tax law. It might reduce or eliminate some of these new deductions for retirees as well that you might have previously qualified for. And again, I brought this up earlier, but for women who are either widowed or divorced, these changes can become even more significant because of that change in filing status, those tax bracket changes. And those Medicare thresholds often can change significantly after these major life transitions. And this is why proactive planning matters so much before major life transitions occur, whenever that's possible.
Okay.
Not because we can control everything, but because understanding these rules, and it can help create much more flexibility later if we take proactive steps earlier on.
Yeah.
So let's talk a little bit more about, and this is probably the most well-known of these what I would call quote unquote cliffs, and that is required distributions or RMDs. And again, we've done episodes on these before, but it's really, again, thinking about the planning strategies, because this can be one of the biggest tax planning shifts retirees face later in life. Partly because many people don't actually know when their RMDs are going to start, because we had so many tax law changes over the last handful of years. It was 70 and a half for years and years and years. Then it went to 72 and then 73 or 75, depending on when your year of birth was. But that creates a lot of confusion because you heard this one thing many, many years ago, and you think that's still the case. And unfortunately, it may not be. Many people spend their entire working careers doing exactly what they were told to do. They contribute to their retirement accounts. They max out that 401k, delay taxes as long as possible. And often, again, this works very well during the accumulation years. But later in retirement, those larger IRA balances can create some planning challenges. Because, eventually the IRS requires you to begin taking money out, whether you need that income or not, right? And those distributions are generally going to be taxable. And so what many retirees discover is that these distributions can create something of a domino effect. So not only do we have this R&D that's creating taxable income, it could increase Medicare premiums. It could cause more of your Social Security benefits to become taxable. And it might push you into much higher effective tax rates than what you expected. And then that's when we talk about this R&D cliff, where all of a sudden we've got a huge influx of income that's creating impact on other areas of your financial situation.
But if I know you, Eric, I know we can plan for this.
We can. We're not going to get to the plan yet. We're working our way there, but
okay.
But I think not necessarily because $1 suddenly changes everything, but again, it's those retirement distributions or required distributions just introduce that new layer of income. And when we're talking about back to our conversation around widows and divorcees, that's again where, especially for the case of a widow, where you have maybe your retirement assets, the value didn't really change. So I've used this example before where maybe both spouses have $500,000 in their IRA accounts. One spouse passes away, and now the surviving spouse has $1 million. Well, now again, they're basing that required distribution off of that single individual versus the joint. And that can have a significant impact on tax rates, on Medicare premiums, all these different variables that we've talked about.
Yeah.
Hi, everyone. It's Eric. Hope you're enjoying today's episode. I want to take just a quick moment to share a resource I think you'll find really valuable. If you've ever asked yourself, how much is my Social Security reduced if I file early? Or am I eligible for benefits as a spouse, surviving spouse, or even after divorce? You're not alone. That's why we created our ultimate guide to women's Social Security success. It includes 6 of our most popular Social Security guides and checklists for women. Inside, you'll find a 2026 quick reference guide with key Social Security amounts and limits to be aware of, along with 5 additional guides and checklists to help you make more informed decisions about eligibility and filing strategies. You can download it for free at womenssocialsecurityguide.com. Keep it handy wherever you may be in the decision-making process. Now, back to the episode. So next thing what I want to talk about is something called and this is what's interesting is that this one is, I still kind of consider it a cliff, but it actually has its own name. So this is something that I consider part of this tax cliff that we've been talking about, but Social Security, it actually has its own name called a tax torpedo. Social Security tax torpedo. Sounds like fun, right?
Let's get on it.
But it's actually pretty simple in that many retirees are surprised to learn that additional income from these other sources can cause more of their Social Security benefits to become taxable. And again, we've covered Social Security taxation on past episodes as well, but it's important to really understand when we're thinking about IRA withdrawals, retirement distributions, pension income, capital gains, even Roth conversions, if you are taking some of these proactive steps, can all increase what's called provisional income, which is what helps determine how much of your Social Security becomes taxable. And this is where retirement planning can become very interconnected, because generating additional income from one source may not only increase ordinary income taxes, it may also cause that increase in Social Security and Medicare premiums. But for example, where the example of using at the end of the year, all of a sudden I had some unexpected expense pop up. Even maybe I had to take, maybe it might be as little as $1,000, $10,000 out of my retirement account, an IRA distribution. And all of a sudden, because of the way the provisional income brackets work, it's pushed me from maybe only 50% of my Social Security benefit being taxable, maybe as high as 85% of my benefit being taxable.
No emergencies then. Just make sure of it.
That's right. You got to plan everything out.
I'm sorry. Please go ahead.
Well, and I was going to make a joke myself about, well, that's why I use a financial advisor, but that's probably a bad example because life still happens. So
yes.
So it's not just the $10,000 that is taxable from the IRA. Most people think about that. They're aware of that, but it's all of a sudden the extra couple $1,000s maybe of Social Security that's now also considered taxable. So that $10,000 distribution might result in $15,000 of taxable income. Right. And again, if you're not understanding how these rules work and how income stacks on top of other income, that's where it really catches up to you. And you end up paying more to Uncle Sam than what you may have had you been aware of some of these rules and said, well, maybe I need that extra $10,000. I can't get by without it. Maybe my AC broke down. I still need the $10,000. But if I have some diversification from a tax standpoint with my investments, maybe I could have taken that from my Roth account instead of from my traditional account.
Okay.
That in itself could potentially make a significant difference.
Gotcha.
So now I want to touch on healthcare costs. Again, this is another one of those areas that really does surprise people quite a bit. And it's, again, what I would consider one of the bigger retirement tax cliffs that people don't anticipate when we're talking about planning for healthcare expenses. Because for retirees, if you're already on Medicare, this is where it often shows up as something called IRMAA, and which stands for Income Related Monthly Adjustment Amount. And in simple terms, it's Medicare premiums increasing once your income crosses certain thresholds, right? And so the first threshold is maybe not have a huge impact, but by the time you're to the second, you're typically doubling your Medicare premiums. And the higher your income is, the more that increase is going to be. Now, what surprises most retirees is that these premium increases are generally based on your tax return from 2 years prior. Okay. So the financial decision, the impact that you make today may not show up until later, and you might have forgot about it. And again, a lot of people aren't aware of how that works, right? And again, for widows and divorced women who are now single, those income thresholds become much tighter as well. So the same retirement income that once worked reasonably well on a joint tax return can suddenly create larger Medicare premiums increases as a surviving spouse once you're filing alone. And sometimes these spikes happen during these major life transitions. For example, you might decide to sell a home, you might be selling investments for income needs, you're taking a large IRA withdrawal. Whatever the reason is, all these could potentially impact what you're paying in healthcare costs, right? And whether that's through because of IRMAA surcharges that you're incurring, or if maybe you're retiring before you're Medicare eligible.
Yes.
Right. And you are on ACA. And again, I just needed money to live on. I had to get by. I take money out of my IRA account thinking nothing really of it. And all of a sudden now it's increasing your Medicare premiums, or it's decreasing those subsidies you might have been eligible for. And just for kind of a basic example, I touched on this a second ago, but just as a real life example that happens quite a bit is if maybe you're widowed, you're divorced, and you choose to sell your primary residence after a few years. Okay. So if you're married, you can protect up to $500,000 from capital gains treatment when you're selling your primary residence. But for single, it's $250,000.
Okay.
Right. So even if you sold the house for $500,000, you might now have $250,000 in taxable gains. But very likely, you might also have much higher Medicare premiums in a couple of years as well. And selling that asset is not one of those life-changing events that might allow you to request a waiver of those higher Medicare premiums. So if you are exposed to those higher Medicare premiums, you get that notification that says that you're going to have to pay a higher amount for your Medicare. There is a form SSA 44 that says if you fall under these 8 specific life events, you can request a waiver. So it's things like loss of income, loss of a family member, loss of a spouse. Those are things that potentially help you get a waiver for higher Medicare premiums. Selling an asset is not one of them, regardless of why you had to do it. If it was just I had to pay my bills, I had to get by, unfortunately, that doesn't really make a difference. And so when you're thinking about how you want to make these decisions, you've got to be aware of these, again, tax cliffs.
Okay.
And we talked about this. If you're not yet Medicare eligible, if you're under 65, healthcare planning can create some different tax cliffs because of the Affordable Care Act. There are income thresholds that allow you to maximize those tax credits or subsidies. But there is a point where once you've reached a certain income level, those basically disappear altogether. And so again, just understanding where those thresholds are so you can make informed decision becomes really critical, especially with healthcare. Healthcare, obviously, money decisions themselves, especially in retirement years, can be really stressful. But when we're talking about healthcare specifically, that just adds that extra layer of stress. When all of a sudden you found out, hey, well, I had to take extra money out of my IRA to pay a bill or to get something repaired or whatever it is. And all of a sudden now it's pushed me above some important threshold that has cost me a higher Medicare premium or lost certain tax credits that might be available. All right, so you brought it up earlier. You wanted to know what the solutions are. So let's start talking a little bit about that as well.
I knew you would have them. That's
of course.
Right, yeah.
Well, because I know it can really sound overwhelming when you start thinking about how these different pieces start to layer on top of each other. Again, kind of that cliff concept. All of a sudden you've got a spike in income or you've got a spike in tax rates. But I think understanding these issues early creates opportunities to plan proactively rather than reacting, right? Because sometimes it's just good planning. Here's one of the tricky things I think for a lot of people. It's not always just about, what are we doing this specific year? right? It's not just about decreasing taxes in this particular year. Sometimes it might actually be intentionally accepting a smaller cliff in the current year to avoid a much larger one later.
Okay.
Right? So it might be something like doing smaller Roth conversions over multiple years instead of waiting until you're having to start taking those required distributions, which creates that bigger tax problem later on. It might be strategically recognizing income during lower income years after retirement, but maybe before Social Security and before you're Medicare eligible or before required distributions kick in, right? So it might be taking smaller chunks out of your IRAs, or it might be selling an asset before you're Medicare eligible. So there might not be that same impact, right? So if you're going to sell something, when would I be best to sell it? When I'm 61 or 62 versus when I'm 63 or 64, and all of a sudden I'm Medicare eligible at 65 and my Medicare premiums have skyrocketed without my really understanding how that process works.
Okay.
And then for some retirees who are, again, under 65, it may just be making sure you carefully manage those income years to maximize those subsidies, those tax credits, and understand what your income sources are. Have I diversified my investments enough to say, well, I may not want to take money out of my IRAs. I may want to take money out of my after-tax accounts to minimize the tax impact, to help me maximize those tax credits. It might be some other more simple areas of saying maybe I'm using qualified charitable distributions or QCDs to help reduce the impact of required distributions. And we've touched on that in past episodes as well, but it's basically saying if I'm giving to charity already, I can give money directly from my IRA to the charitable organization. It qualifies for satisfying my RMD, but I don't have to pay tax on those dollars. Again, it's not, in many cases, it's not these huge dramatic changes. It's these smaller proactive adjustments that you can make over time. But those smaller adjustments can sometimes create much greater flexibility later, especially for women who may eventually face this widow's penalty or those changes in filing statuses down the road.
Okay.
Right. And I think this is where doing tax projections, doing this ongoing retirement planning, going through an ongoing retirement planning process can become incredibly valuable, because the goal is not always eliminating taxes entirely. I would even make what I think is a pretty good argument that if you have a year where you paid zero tax, that was probably a mistake. Whether it was simply saying, if I was in that low of a tax bracket, could I have utilized Roth conversions? Could I have recognized certain income now at a lower tax rate, because I've just said, well, I don't need my IRA money, so I'm just going to leave it there. So I just say, well, I didn't pay any tax this year. Well, all of a sudden, a few years down the road, now I'm paying much more in taxes because I chose not to pay taxes this year.
Right.
Right. So again, it's all about being strategic, and I think ultimately creating a sustainable and flexible retirement income strategy over time. And again, for women who are divorced, widowed, managing finances independently, just understanding how these moving parts can create a much greater sense of confidence around future decisions. Because I think when you understand how these pieces fit together, financial decisions often become less intimidating. Not necessarily easier, but just much clearer. And actually, when you're in these situations where you've gone through a major life event, that's where clarity really becomes that much more important. All right. So we've talked about several of these retirement tax cliffs that can quietly affect your retirement income planning. For more required distributions, we talked about Social Security taxation, Medicare premiums, healthcare costs. Many parts of the retirement planning are much more connected than people do realize. And again, for women who are navigating retirement after divorce or widowhood, these interactions have become even more important because of those changes in filing status, income thresholds. Healthcare costs often change significantly after major life transitions. And I think one of the biggest themes throughout today's episode is that retirement planning is no longer just about generating income. We want to make sure that you're coordinating where income comes from, when you take it, how one decides, or how one decision can actually affect several other parts of your financial life at the same time. And again, this is why proactive planning, tax projections, understanding your options become so valuable, because it's not about making the perfect decision. It's just about creating flexibility and avoiding unintended surprises later.
Okay.
And I've referred to a few different episodes that we've covered in the past. So if today's conversation raised some questions about required distributions or the widow's penalty, Social Security taxation, we've covered these episodes or covered these topics on past episodes. So we're going to make sure we include the links to these episodes in the show notes as well, to make sure that if you would like to go back and take a deeper dive, then you'll have the opportunity to do that. All right. So anything, Wendy, I always come back and ask you this, but anything you felt like was difficult to understand, anything we need to go back over that you felt like would be helpful? All of it?
Yeah.
So RMDs.
Stop asking me this.
So I'm gonna shoot you the link to the episodes as well. How about that?
Okay. All right. Sounds good.
Well, thank you so much for tuning in. Thank you, Wendy, as always, for joining me. Again, if today's episode showed you how easily taxes, Medicare premiums, and required distributions can overlap in retirement, that's exactly why proactive planning matters. If you're looking for a personalized retirement plan that helps you make smart decisions around income, investments, taxes, Medicare, long-term retirement planning, you can visit getmysimplyretirementroadmap.com to schedule a call with our team. That is it for today's episode. For all the links and resources mentioned today, you can visit the simplyretirementpodcast.com. Please don't forget to like, follow, and share the show. And until next time, please remember, retirement is not the end of the road. It's the start of a new journey.
You've listened to Eric on the podcast and heard conversations about retirement income, Social Security, taxes, investing, and many of the financial and non-financial aspects that shape retirement for women. But you may still be wondering what sets Blake Wealth Management apart from other retirement planning firms. The answer is quite simple. At Blake Wealth Management, retirement planning is about more than investments. Eric's passion for helping women comes from the strong women in his own life, including being raised by a single mother and watching his grandmother navigate widowhood at just 62 years old. Those experiences continue to shape the mission behind this podcast and the work we do every day. Whether you are planning retirement with a spouse, navigating retirement on your own, or simply preparing for what may come next, the team at Blake Wealth Management is available to assist you with your retirement planning needs. Visit blakewealthmanagement.com for a free retirement assessment or call 972-426-7237. Content here is for illustrative purposes and general information only. It is not legal, tax, or individualized financial advice, nor is it a recommendation to buy, sell, or hold any specific security or engage in any specific trading strategy. Results will vary. Past performance is no indication of future results or success. Market conditions change continuously. This commentary reflects the personal opinions, viewpoints, and analysis of Blake Wealth Management. It does not necessarily represent those of RFG Advisory, their clients, or their employees. This commentary should not be regarded as a description of advisory services provided by Blake Wealth Management or RFG Advisory, or performance returns of any client. The views reflected in the commentary are subject to change at any time without notice. Advisory services offered by investment advisory representatives of RFG Advisory, a registered investment advisor. Blake Wealth Management and RFG Advisory are unaffiliated entities. Advisory services are only offered to clients or prospective clients where RFG Advisory and its representatives are properly licensed or exempt from licensure. No advisory services may be rendered by RFG Advisory unless a client agreement is in place.